Hello everyone, welcome to Blue Dragon Actual. So today we are going to cover two regulation. One is IRDA preparation of financial statement. It's a big regulation, but we don't require everything that is kind of there. We need a part of it, and also the investment regulation. It is once again a big regulation, but it is written parallelly jointly for life insurance, general insurance, pension. So we don't require all of that. We require only a very small section. So, and this would also finish our regulation related to investment. As you know, like our last week theme was kind of investment and capital management, and that will like come to an end with the regulations on. There are two couple of regulations on capital that is still left. But however, the most important regulation it would be ALSM. So tomorrow I am going to do the APS 7, which is for MAD and PAD, and then the next day I think I can do the LSM regulation. And yeah, so that's the plan, followed by maybe two chapters, because this week I have not covered many chapters. It was mainly focused on regulation. So maybe profit reporting on Saturday and analysis of surplus on Sunday. So we'll see how it goes. But anyways, moving on. So preparation of financial statements and auditors report. This is like how the entry goes and how you value those entries, and mainly for the asset. Those are covered here. So it is a 2002 regulation. Now, as per the accounting standard, so every life insurance kind of carrying life insurance business need to follow the regulations that or the guidelines of were issued by ICAI. And the balance sheet, the P&L account, which is the shareholder account, because the profit in P&L belongs to the shareholder, right? The revenue account, which is the policyholder account of this. This is the profit or the surplus that arises in the participating policies, and that belongs to the policyholder, right? So by this method or by this logic, by up to this point, we can understand that it is kind of split into two parts. One is for participating, one is for non-participating. The financial statements would be like that, right? And it is also split for business which is carried out in India, which is carried outside India, and it is also split between linked business and non-linked business. So these are the segregation that happens in financial reporting. So participating, non-participating, business within India and business outside India, linked and non-linked business. But and and for participating business, revenue account will be produced, and for non-participating business, shareholder account or the P&L account. We kind of interchange these terms, revenue account and P&L account, but that's not actually correct. For participating business, revenue account would be used, because you are only uh, kind of concerned with the revenue or the surplus that is kind of happening there, because you don't have claim to the entire, as an insurer you don't have claim to the entire surplus. So yeah, moving on. So for that, they have to kind of follow the guidelines issued by ICI. But the guidelines, but there are some exceptions, which is AS3, which is basically the payment and receipt statement, which is also known as the cash flow statement, and that has to be made under direct method. So it is a accounting standard. I'll not go into detail what direct method is. And in any case, as per CB2, cash flow statements are not required. They are not part of syllabus. And the next would be A17, which is segmental reporting. Segmental reporting is exactly what I just told. So you have to split everything in segment, participating, non-participating, etc. Segmental reporting, and whether the company is listed or not listed, it would be segmental reporting. Now premium. So premium we will see in. So there are different standards who kind of consider premium is kind of when the premium is received, they recognize that in the financial statement. For few, when the premium is accrued, they are recognized. So normally the standards that I have seen, they kind of recognize the premium when it is accrued. So in this case also, the premium is recognized when it is due. For linked business, the premium will be recognized when the units are getting created. Okay. Now for premium deficiency, so premium deficiency usually happen for group business or health business, just short term kind of business. For that, premium deficiency happens. So premium deficiency is usually calculated as the premium deficit, if the expected cost of the claims and the associated expenses and maintenance expenses, etc., is less than the expected unearned premium, that is the premium that we have not earned. So then there would be a premium deficiency reserve. Then there will be premium deficiency, and that's what we call premium deficiency. So I think if someone has studied SP1 they have probably studied this concept, which is the premium deficiency reserve. This only happens in short-term business where you receive a portion of the, like you have received the premium, but you receive the premium for the entire year, and some portion of it, suppose 3 months have passed. So for 3 months of premium, you have kind of realized. Suppose you have received 1200 rupees, so you have already realized 100 rupees. That is 12 by not 100 rupees, 12 by 3. That is 400 rupees you have realized. Remaining 800 rupees here, you have to kind of realize those. That is called that is kind of called the premium, unearned premium. You have not yet earned that premium. That because the premium is paid for the entire year and only 3 months have passed, only one quarter have passed. So you have only recognized or only earned a premium for the first quarter, but you have not earned the premium for the next quarter. However, if the claims or the expenses that is associated and you are kind of projecting for future and you see that is more than what is the unearned premium, then there is a deficiency. You need to keep reserve for that. So that is for unearned premium. Acquisition expense, if any, is expensed out in the period in which it is incurred. This is slightly different from US GAAP or IFRS 17 also, where you have chance to defer the acquisition expense. So this is deferral of acquisition expense is kind of done in order to increase the profit in the first year. So there is a concept called DAC. So suppose you are which is deferred acquisition cost. Definitely, suppose you have 100 rupees as acquisition expense in the first year, so you can defer it over a period of 10 years. So for example, for every year you are going to recognize 10 rupees. So what it will do as compared to the previous scenario? In previous scenario, we would have recognized 100 rupees as acquisition expense in the first year, and that will reduce your profit. But in this case, you are only recognizing 10 as the profit in the first year, so the first year profit will increase. But in the first scenario, you will not recognize any acquisition expense in the remaining years. Right? So in that case, the profit will increase in that scenario. However, you would be recognizing an expense of 10 in each of the following year, and hence the profit in the following year will decrease. So this is a technical, I mean, this is a method that is followed in US GAAP mainly. IFRS 17 also kind of allows for that. But if you are recognizing all the acquisition expense in the first year, that is a prudent approach, and that has been followed in India. So that has been stated here. Any acquisition expense that is incurred, that is expensed out in that period only. You cannot defer that acquisition expense. So moving on, coming to the actual evaluation or actual investigation. As we know that reserves are kept only for enforced policies. You don't keep reserve for lapse policies in life insurance, right? And that how you are going to determine the assumption depend on the financial investigation that they actually has to carry out. The appointed actually basically has to carry out, and the assumptions would be disclosed by notes to the account. Now, what are the types of assets that an insurance company can invest in? And this is an area where many people has very limited knowledge, because I mean, we deal with liabilities because actuaries are owner of liabilities, but actually do not understand much about the asset side because they have not worked in the asset side. So first is the real estate investment. So we know that to beat inflation, we can invest in real estate, right? So real estate investment. Now, real estate investment is kind of measured at historical cost, but it is subject to revaluation. Then the revaluation happen once every 3 years. So every 3 year, the company will revalue its property or asset to see what is the value of the asset or property currently. And we know that in India, at least retail investment is a very good investment. At least the parents love that. My father is kind of telling me to purchase a house for last, I don't know, maybe for 5 years, that to purchase an asset, get some asset, it's a very good investment. And the fact, like, everyone believes that if you purchase a property, value will increase, because that's how it has been the case in India. Although in UK, the main cause of 2008 recession was kind of property estate bust, and I mean that's how the recession came. So in India, we have only seen the property price rise. That's not a good approach, but that is not the topic for this video. So moving on to the main topic. So you once every 3 years, you are going to revalue your property asset. Now, any unrealized gain because of that revaluation will flow into a portion or flow into an account called revaluation reserve, which will come under the equity heading under the balance sheet. So you know your balance sheet has three components: asset, liability, and equity. So it will come under the equity section, revaluation reserve. and that revaluation it will come under the revaluation reserve. So but any accumulated change now after the sell or the, so the first thing that I mentioned was for unrealized gain, but for realized gain, whatever has been accumulated in the revaluation reserves will be recycled back to the profit and loss account as profit and loss, and it will like it will flow to the profit and loss account. So if one can disclose the basis of revaluation through notes to the account, the policyholder can be paid bonuses from the revalued account. However, for avoidance of any doubt, shareholder cannot be paid anything from the revaluation reserve because it is unrealized gain. The gain has not been realized yet, and that's why shareholder cannot be paid anything. Now, if there is a loss in the revaluation, then it would be treated as an immediate expense if it is beyond the carrying value of the carrying value of the estate, basically carrying value of the real estate. So what it means is if you are making a loss and that loss is kind of more than the then that loss is more than what is kind of kept in the revaluation reserve, then that would mean that there is an so then the excess of the loss over the revaluation reserve will be treated as an expense and it will flow to the P&L account. So basically, if you are making a loss and that loss is also surpassing the previous gain that you have made in the previous unrealized gain that you have made, especially in a, so this can happen in a scenario of price crashing, right? So moving on, so then there would be debt securities. So we know one of the main investment of insurance would be in bonds, and government bonds and corporate bonds have gone through that chapter called investment ALSM chapter. So there, the main investment because of the way of the non-participating policies, mostly insurers write non-participating policies. So we have a lot of investment bonds. So bond securities are fixed income securities that includes government securities as well as redeemable preferential shares. Those are kind of measured at historical cost and subject to amortization, right? So those are treated as a depreciating sort of asset because there is amortization. So yeah, that's it. Now moving on to the listed equity and derivatives. So as we know, derivatives are used for hedging, and listed equity means they are traded actively in the market, and because they are traded actively in the market, they would be taken at fair value. That's the basic concept of market consistent valuation, which you have kind of learned. So listed equities and derivative instruments would be treated as fair value, subject to impairment provision. Now, the equities and the derivative instrument will be assessed at each balance sheet date, as compared to the real estate, which was happening every 3 years. Here, the assessment is happening at each balance sheet date. Once again, the treatment is same as the real estate. Unrealized gains or loss will move into an account under the equity heading, which is called the fair value change account. Right? It was a revaluation reserve. Here it is fair value change account. And any loss or gain arising from the sale of the asset, actual sale of the asset, will be kind of consisting of the accumulated value in the fair value change account and will recycle back to the profit and loss account. The profit or loss, the profit would flow through the when you are selling the asset, when you are kind of getting rid of the equity or derivatives, then it will flow to the profit and loss account. Once again, you can provide bonus, and the basis of impairment, the basis of impairment can be can be disclosed to the notes of the account. You can provide bonus to the policyholder, but you cannot use the fair value change account to provide any bonus to the shareholder. Now, there is also, if there is loss in the fair value, if there is loss or if there is an impairment, then it would be treated as an expense if the remeasured value of the equity, because the value of the equity always changes, right? And for the purpose of this regulation, fair value means the closing price for an active or for an equity in an exchange. Let's say for the famous Axis Bank example, so what is the closing price at 3:30, because the market closes at 3:30. There is also a post market after that, maybe the price change. So maybe the closing price of the market at 4 p.m. Because there is a post market which in which the retail traders cannot participate, only the institutional trader participate. So the price change based on that, and also there is some weighting average, the weighted average that is kind of applied in India Stock Exchange. So that would be the price, the closing price of an actively traded exchange, of a share in an actively traded exchange. So that would be the price. Now, There would be impairment because if there would be if there is a loss, then the remeasured value of the equity along with its acquisition cost, if that value is exceeded by the loss, then it would be treated as an expense. However, there might be a reversal of impairment loss, and if the previous impairment loss is kind of recognized as expense in the profit and loss account, then this would be recognized as a profit in the or revenue in the profit and loss account, because it's a reversal, right? So earlier it was an expense, so now this time it will kind of reverse that entry, so it will be treated as revenue. Now, unlisted equities and derivatives, unlisted equities and derivatives, they cannot be measured at fair value, right? So they has to be measured at historical value subject to. So there would be a reserve that would be kept, which would consider the diminution in the value of that investment. But that reserve can be reduced if there are external evidence suggesting otherwise. However, the reduction would not cannot make the value or the price more than the historical cost. So there is a cap. The historical cost is the maximum price that can be used for the unlisted equities and derivatives. Then there is the insurance company also has loan asset. So loan asset is basically where the insurer should carefully consider the the value of the quality of the loan subject to, and it should measure it as historical cost subject to impairment provisions. The impairment provision should not be less than the loans which are defaulting of as such, the following under where the whether the interest has remained unpaid for more than 6 months, and the installment has been failed for a period of more than 6 months. So if the loans are of this nature, then provisions should be kept for that, and that would reduce the value of the loans, right? Then there is listed securities. So listed securities would, for the valuation of the each segregated fund has to be disclosed separately because of the segmental reporting, right? And the wherever the funds are invested in, they need to follow the approaches that we have just discussed. That is for real estate. If they're invested in real estate, the same accounting principle, valuation principle that is followed for real estate will be followed. Similarly, it would be the same thing would be followed for the fixed interest securities in that way. FFA is something that we have discussed for participating business. It is the portion which is kind of equivalent to the free capital of a non-participating business. So FFA is something whose distribution to the shareholder or policyholder is not determined by the end of the financial year. It's fund for future appropriation. So this is the regulation. Basically, there are other portion in the regulations which are not that important, which are written for disclosures of financial statements and general instruction for preparation of financial statements. It is not that it is not important from understanding. So one can kind of read through this, but these are very simple to understand, and you don't have to memorize this, and you can understand what is kind of written there. But and mostly it would be related to solvency, it will be related to liability, asset, etc., segmental reporting, etc. And one of the things that I would like to kind of mention here is the participating policies, non-participating policies, linked, non-linked, health business, business within India, and business outside India. Right. So this we have already covered because of the segmental reporting, and this is kind of because we are using that AS17 concept, and that's why we kind of have to do that. So this time I have kind of I was trying to move, although I was kind of saying whatever I need to say from the memory. I was kind of following the document. I was kind of moving the document along with kind of scrolling down along with what I was saying. So I'm not going to kind of read through this page once again. So I think most of the things have been covered, and yeah, I'll provide the link in the description. You can do that. And just a rule of thumb is everything usually is kind of measured at historical cost, other than the listed equity and derivatives, because you can see the value in the market, and that's why it is easier to determine. Otherwise, everything is valued as historical cost, and they will be subject to something, either a provision, impairment provision, or revaluation. Something would be there. So most of these assets are treated as depreciating asset, right? So that's the catch that we have to remember. That's how, and you can see these are very prudent type of valuation, right? A more aggressive valuation will not treat it like this. This is how Indian company values it. So moving on to the IRDA investment regulation, this is a very small section. It's a big regulation, but it is written for life insurance, general insurance, and everything. We only need to remember where the what is the exposure limit for investment regulation. Otherwise, we know what are the investment, that there is investment in money market. We already have gone through those things. You match with the liability, nature, term, currency, and uncertainty. So you have already gone through those, right? There is no need to kind of repeat that. The only thing that is kind of important in the regulation is where how much we can invest, what are the exposure norms. So a life insurance company can invest its fund, which is also known as the control fund, in shareholder fund. Shareholder fund, we have already know what is the shareholder account, right? The policy P&L account. Now, shareholder fund, which would be excluding the solvency liabilities up to solvency margin. So basically, you can invest. So when we are talking about this fund represents the available capital, and the insurer shall invest and shall always remain invest in the shareholder fund. Then the IRDA, or which is also known as 1 year renewable pure group term assurance business, that is also known as IRDA, and the non-linked reserves of the linked business. So the insurer shall always keep this fund invested. So these are the types of funds. First of all, we need to understand what are the types of fund, and then we'll come to the exposure limit. So this is one type of fund. The next type of fund is pension, annuity, and health business. The other type of fund is obviously the unit reserve for the linked business. These are the types of fund that an insurer will usually have, and the insurer can once again split those fund into further subcategories. They can earmark a fund so that a fund can may stay within a fund, which can happen for participating business. The non-participating, if non-participating business is written in participating business, then that can be earmarked. So there are a lot of I mean, judgment that is involved there. However, for our purpose, the investment in, but all of this investment would can be in central government securities or government securities, and we have already seen that, right? We have already seen the investment that the insurer can make. It can only invest in real estate, it can only invest in fixed income securities or listed equities, and we know how it is valued. So right now we'll know how the exposure norms are. So for central government securities, it state government securities and other approved central government securities, state government securities, it cannot be less than 25%. For central government securities, state government securities, and other approved instruments, it cannot be less than 50%. However, if we talk about only other approved instruments, which also consist of the other investment, which is part of 27A, then it would be less than 50%, and other investment have to be less than 15%. Right. So the most of the focus is in central government securities or state government securities, because that is where the risk is less. Once again, a prudent approach. The insurance can also invest in infrastructure, which is in investment in housing, investment in infrastructure, and in that case also the maximum exposure would be it has to be less than 15%. It cannot be more than 15%. So mostly it is investment in state government, central government, and other approved instruments. In other approved instrument, there will be upper limit, but in state government and central government, there is a lower limit. Right? That's how I remember it. State government, central government would be 15, 20 to 20, not less than 25%. And when it comes to other investment, it will be not more than 15%. Right? So that's how it is. This is the only thing that is there. Investment regulation, it is a regulation of 2016. As I mentioned, it's a big regulation. There is also a portion of risk management which one can study, but I think it's kind of is ingrained in the chapter which is risk management of SA2, which we are going to cover. And if you have studied ST2, you have studied about that. Also, the derivative portion, the risk management is kind of related to the derivative portion, which we have already covered, the derivative circular. If you remember that, it has to be, the derivative activity has to be in accordance with the capital strength and the business objective, right? You have to define risk management and risk management function. So all those are kind of covered in here as well. And the derivative circle is a part of this regulation as per regulation 18, if you remember. Earlier it was regulation 13, and now it was regulation 18. So yeah. So I'll stop here, and I hope you are enjoying that MBA versus actuary video. I think I tried to give max, like whatever I know, I was able to kind of give that there. Please like, share, and subscribe to that video, to this video, and provide your feedback if you don't like something, and how I can improve. So yeah, thanks for watching and see you tomorrow.